I do still think that there's some risk here that gold could get one more move to the downside, maybe 2190-ish, but ultimately that's short term. I continue to be insanely bullish on gold. Central banks, even though China's kind of stepped back on buying, central banks are still loading up overall. And I
Yes.
think that's a huge narrative that tells you. And I always say this, I think we even talked about it last time when I talked about China and some of these central banks doing this, is that if the players that are creating the monetary supply are loading up on gold, it tells us everything we need to know. It's such an easy answer of where the currencies are going to go and then where gold is going to go.
The price of gold retreated during the North American session as investors processed Federal Reserve Chair Jerome Powell's remarks at a European Central Bank forum in Portugal. Despite Powell's slightly dovish tone, U.S. Treasury yields remained steady while the dollar fluctuated within familiar ranges. As a result, gold dollar traded at $2,324, down 0.28%. Gareth Soloway, chief market strategist at Verified Investing, offers a nuanced outlook for gold. He suggests a potential short-term decline to around $2,190, but maintains a bullish long-term perspective. Soloway points to ongoing gold accumulation by central banks as a key factor, interpreting this as a sign of waning confidence in fiat currencies and a positive indicator of gold's future strength. Although China did not purchase gold in May, analysts believe this doesn't signal the end of its buying program. They note that even after 18 months of acquisitions, China's gold reserves represent only 4.9% of its total foreign reserves, suggesting room for further expansion. The outlook for silver presents a more complex picture. While the long-term prospects remain favorable, the metal has recently broken below an upward trend line, hinting at potential short-term weakness. The downside of the Soloway project is around $27.75 or $27.50. The anticipated economic recession could temporarily pressure silver prices, mirroring recent declines in industrial metals like copper and nickel. However, silver demonstrated resilience as Tuesday's North American session concluded. The metal traded at $29.51, registering gains of over 0.20%. Silver prices rose as Powell acknowledged more balanced risks to the Fed's dual mandate during an ECB event. Join us as we delve into Gareth Soloway's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
If retail buyers haven't shown up yet, it means that there's a lot more upside to go on gold. It's usually when retail buyers FOMO in that's the end of the move, right? And that's where the institutions start unloading to those retail buyers. And you can see that in almost all bubbles. You go back to the dot-com era, you go back to almost any period. The upside in a market finally lures in the retail crowd that's been kind of scared, skeptical, and then that's obviously the top. And unfortunately, they become bag holders. But looking at the gold chart, we did get up to that 2,400 and change level. And then what's going on right now is just what we call price kind of, digestion. So you had this big kind of move up straight up, you pulled back, you retested those highs and it failed to break out. And we have what's called a wedge pattern on the chart. And wedge patterns basically mean that price is above this low, but below this high. And it's digesting, it's going sideways. Now, I do still think that there's some risk here that gold could get one more move to the downside, maybe 2190-ish, but ultimately that's short term. I continue to be insanely bullish on gold. Central banks, even though China's kind of stepped back on buying, central banks are still loading up overall. And I
Yes.
think that's a huge narrative that tells you. And I always say this, I think we even talked about it last time when I talked about China and some of these central banks doing this, is that if the players that are creating the monetary supply are loading up on gold, it tells us everything we need to know. It's such an easy answer of where the currencies are going to go and then where gold is going to go. I think the problem with the retail investor is that gold has notoriously been such a poor performer compared to, tech stocks, compared to so many of these other things, even Bitcoin, right? I mean, historically, it's still lagging the incredible move over the last 20 years in Bitcoin, that there's just this skepticism. And they say, well, why would I go into something that's going to move 10% a year maybe when I could go into NVIDIA and make 100% a year? And so this is the issue, is that the retail investor kind of chases those incredible gains, while the bigger investors, kind of the investors in the know, they position themselves for those bigger macro moves, which would be the long trade on gold, maybe on silver as well, and some of the other metals. But I do think it's more that the retail investor just wants to be in the quick, they want to get rich quick. I mean, unfortunately,
Right.
I tried that when I was younger and it didn't really work too well, frankly. I always over leveraged, I lost a lot of
Yeah.
money. It's about looking at the bigger picture and taking it slow.
Are you as bullish silver as you are gold?
So the short answer is over the long term, yes. But silver right now has broken below this upsloping trend line in the near term, and as long as it stays below this trend line and below this channel, this is again the two parallel lines give us a very direct high and low on silver recently. I would still favor some downside here. I think again we might pull back to around 27.75, maybe 27.50, and I think the key is this: is that you have multiple factors here working with silver. So silver, the precious metal, the kind of the way to store safety or semi-precious, and it's a way to kind of offset the printing of money. There's no doubt about it. The negative is it's the industrial side, right? And I'm still a huge believer that we will head into recession here. It's taken a lot longer than I thought because I think the US government has just been printing and spending so much extra money that has offset some of the work that the Federal Reserve has done on tightening monetary policy. But ultimately, it will happen. And at that point, you will see a weaker economy maybe push silver down and some of these other industrial
Mm,
metals. We've already seen copper decline about 15% off of its recent highs. And nickel, I don't know if you guys look at nickel, but it's down 21% off of its basically 6 week ago highs.
The U.S. dollar retreated on Tuesday in thin, volatile trading following Federal Reserve Chair Jerome Powell's moderately dovish comments at a monetary policy conference in Portugal. Powell's remarks highlighted significant progress on inflation and a return to a disinflationary path, and suggested that the Fed might initiate its easing cycle later this year. Market analysts interpreted Powell's stance as dovish, contributing to the dollar's weakness. Soloway notes the dollar is trading within a defined range, with upcoming jobs data crucial for its direction. Robust data could push it higher, while weak data may cause a downturn. Meanwhile, attention is shifting to Japan, where bond market participants anticipate a significant policy shift. A Reuters survey indicates that the Bank of Japan is expected to reduce bond purchases by approximately $100 billion in the first year, under a quantitative tightening plan set to be unveiled this month. Soloway warns that Japan's potential sale of U.S. debt in dollars could force the Fed to intervene by purchasing this debt. This action might expand the Fed's balance sheet, potentially worsening the U.S. fiscal situation and increasing national debt. Let's get back to the interview.
The dollar has remained very strong. If we look back in the January or December of 2023 period, we've actually seen the dollar trending higher for this entire year. And the key here is just understanding that the US dollar is versus all the other currencies, right? It's a basket of currencies, including the euro, including the yen. And so the dollar is staying strong relative to those currencies because those governments and those Federal Reserve banks, they're all already starting to cut rates. And we've seen Canada do it. We've seen the European Union start to do it. And that, again, weakens their currencies and therefore the dollar strengthens in response. So, I think there's a big misconception here that the dollar staying strong means US citizens have like more buying power. It doesn't mean that. It essentially just means versus other currencies, our currency is still kind of the cleanest shirt in a dirty laundry basket, if you will. Now, looking at the chart, what I'm seeing here is that we are kind of getting sandwiched between a resistance line as well as a support line. And I do think the jobs data this week will be instrumental in either this chart breaking up, the dollar breaking
right.
out with stronger data, or if it's a little bit weaker on the jobs front this week, we might actually see it turn back down as expectations for the Fed to kind of catch up to the other central banks with cutting rates starts to kind of jump a little bit. The Japanese central bank intervened right here on the chart. It was looking to pop out of what we call a channel, parallel lines that's keeping the dollar yen within this zone. And they came right in and just slammed it back down. The problem is it didn't last. And now all of a sudden we find ourselves at new recent highs with a potential upside target of this 163 to 164 level. And the kicker here is, and what most people don't understand, like this is a chart that you're not hearing about on CNBC or Bloomberg very often. But the reason why it's such a big deal is, and the US just came out, I think it was last week, and said, we're going to put Japan on a list of potential currency manipulators. And the reason why it's
Wow.
such a big deal to the US is because for the Japanese central bank to strengthen their currency, they must dump US dollars and US debt on the open market. And when you do that, you cause issues over here, right? I mean, everything in this world is so interconnected right now, where Japan has 250 debt to GDP, and they're the biggest holder of US debt. So they start dumping that.
Exactly.
And what ends up happening? Interest rates here get artificially pushed up because of that excess supply on the market. Well, if the Fed is trying to keep interest rates in this zone or even drop them, let's say the US economy starts weakening and they start dumping US debt, it actually could take control away from the Federal Reserve in terms of monetary policy. And that's where things get really messy if that does happen. My guess, unfortunately, is that the Federal Reserve would have to eat up that debt and have to expand their balance sheet. And that way they would take it off without
Exactly.
interest rates being negatively or inversely affected. And that's the last thing, if you're looking at me and a lot of Americans, the last thing we need is the Federal Reserve balance sheet to expand exponentially again, like it has in the past, and the US debt, which we know where that is right now, near $35 trillion. So, if they start unloading that, it just means that we get in a worse position fiscally. And the outcome of that, unfortunately, is there's no good outcome. It's an outcome where you print more dollars to pay down debt down the line, and essentially you debase your currency.
Given the complex interplay between gold prices, silver market dynamics, US dollar movements, and potential policy shifts in Japan, how might investors best position themselves to navigate these interconnected market forces in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.